the Precision Concepts video series. This is the last in the series. In the first series volume, we talked about weekly order flow, and the second volume, we talked about weekly order blocks. And now, to bring this series to a conclusion, we're actually going to be looking at the concept of trading inside the range. Okay, and this is a concept that I use to teach my kids how to trade with it. And I always try to find a way to conceptualize what it is that I see in the marketplace. And because I don't have another source readily available, so I can just take them to it and say, okay, this is what it is that I'm referring to. I kind of dubbed it as an L7 range. Okay, and L7, kind of silly sounding, but what is it exactly? Well, whenever you're looking at a price chart, and I have purposely picked the US Swissy pair, and it's because I believe this is the king of volatility in terms of pairs. If you were to look at any one of these reaction high and reaction low, and this is a daily chart of the Swissy, I'm going to draw your attention to a few things, and I want to show you that if directional premise is a stumbling block for you, it need not be, because it is not necessary for you to have a directional premise at 100% of the time. Okay, if you're comfortable trading inside of dealing ranges, okay, it's quite lucrative actually if you understand what it is specifically you're doing when you trade inside of a predetermined range. And what do I mean by that? Well, the reason why I dubbed this as the L7 inside the range concept is because if we look at, say for instance, this range here, okay, this low to this high, and we'll define it by this. And this is a rather simple concept, but it's absolutely amazing if you apply it in your trading. And actually, if you start looking at it as a training exercise, trade within a predefined range, because our understanding is obviously the markets are 70% of the time in a trading range. Now, the definition of that, okay, was one of the longest stumbling blocks for me as a trader when I was first developing, because I always misunderstood what they were saying. Like I assumed this was the trading range here, okay, but I looked at this and said, okay, well, if this is a trading range, okay, and look how much time it spent out of there, and it rallied up here and rallied up here. To me, it seems like it's always trending, and spent very little time inside of a trading range. It wasn't until I understood the natural ebb and flow in the marketplace where it became quickly apparent as to what that statement means when markets are 70% of the time inside of a trading range. We have a high here and a low here. The range is defined by this low and this high. The likelihood of price moving out and continually to move higher is rather low. Okay, in other words, you have the way I interpret it, and you can go with this if you want. I view this as we have a 70% odds that this market is going to have a very difficult time breaking out to run to new highs. Now, it could stab through. The way I interpret that is that as the market begins to move outside of that range high, that statement indicates that it has a 70% chance of failure to move to new highs and continue on higher. Okay, yes, we see a violation on a few candles on the daily chart where it did in fact sweep above that range high back here, but ultimately what did it do? It returned back inside of the defined range of this low and this high back here. Okay, so how can we use this information, and what does it mean, to us as a trader? Well, as price trades down and makes a low here, I'll ask you this. What do you think the least least road of resistance, okay? Is it to go higher or is it to go lower? Because we've already went lower than this low here. We went lower than this low here. We took out this high with a very small minor move here, but we've recently started to move higher. If you start looking at this like a letter L, okay, envision a letter L here. We're trading down here at these levels here. Where is the point of reference for this range? If we're at the lows here, it's up here. Okay, so now how do we incorporate that? Well, at this old high, if we start looking at the order blocks that represent the selling that caused the market to drop, we'll look at a few of them. We have, this is a Sunday, so I'm going to avoid that. We're going to say this is the um, first bullish candle prior to this Sunday here. And if we're down here, we could look to see if price would rally back up to that price point. Now, yes, invariably we could probably see it retest this high, but what did we already state? That markets have a 70% likelihood of staying inside of predetermined ranges. So if we could find a long down in here, we could look for this market to move higher up into this level here. Now, also note that we have this shorter term range from this high, and all I did was note the bullish candle prior to the drop down in this low here. So this is a predetermined range as well. If we were long here, we could look for initial objectives in here, and if this high is taken out, reasonably expect this order block here to be retested, and if it continues to trade even higher, we could retest this high here and maybe look to see some kind of a sweeping event like we see many times in my videos or in commentary. So as the market also traded in this range with this high here and this low, the range was this high and this low. If we could find a long in here, we could trade inside the range and look for this bearish rather, this bearish ICT order block to be retested. Okay, we entered into that same area, had a small little turtle soup, which is a false break above an old high, and then rejection. Okay, but I'm not trying to teach that pattern here, so I probably shouldn't have said that, so it is what it is. But any long in here, your objective would be to look for the counter order block that saw price drop down. Okay, we would try to trade back up into it. This would be a known level of institutional selling. Okay, and you can see that does in fact come underway. The market does drop down precipitously. We're using the L concept in here of this particular approach. Okay, and it's probably an oversimplification. Okay, but to me it just makes sense, and it helps my kids learn this as I teach it to them. So we have a point of where we are now and where do we go from here. Well, the range high is here, so that would form a letter L. Okay, and it probably sounds like Sesame Street to the people in the States, but it really is a rather simple approach. Now, how do we approach a 7 range, okay, or the concept, how does the 7 come into play? Well, if you look at, let me get some of these lines off here because it's going to get in my way here. Price at these levels, okay, and we're not going to reference anything over here for now. We're just going to look at where we're at in terms of the dealing ranges and such. We have this high here, and we see price run up back into the order block here, and when we start to sell off. If we were able to see something bearish back here, okay, the point of reference is what? Here's the area where we're at. The likelihood of us continuously breaking higher, okay, because this was the previous high. Price rallied out of that. Okay, now it's several hundred pips because it is a daily chart, but look what happened. It was unable to stay above this range high, so it pulled back inside of the range. to run below this old low. But more importantly, okay, it's this range low here and the new high that it formed. So we have the dealing range is this high, this low. So if you're up here hunting sell signals, okay, where's the range? Well, we have several ranges to deal with. So that's the question and why I always ask, where are we inside the dealing, what dealing range are we within? We have these highs, we have a reaction low here, so that's a point of reference. Okay, this is one point of reference. This is another point of reference. Another point of reference. And another point of reference. Okay, so these are all ranges that price works within while trading. Okay, this low here, price bounced off. This is pretty nice. Obviously, price came down into this low here, swept it just a little bit, and then rallied even more. Okay, price, when we made this range here, we have this high and this low. Okay, where's the path of least resistance? Okay, it's going to be on the upside because it's been dropping lower, 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 and now the only thing that we got to consider is where the stops are, and that's where the price is going to seek. It's going to seek liquidity because everything's been going lower, so eventually there's going to be a lull in selling. So what will happen is the market will reach up and seek out liquidity above the short-term highs and see if there's any stops. But still notice, even as aggressive as this bounce was and rally higher, where does it run back to? Previous order block. Okay, this bullish candle prior to the drop lower. If you want to use this candle as well, you're still within that same range. Okay, right here. Okay, so inside this range, we've come all the way back up to here. Okay, so now, again, while price is right here, is it likely to continue and break through this high and trade under the new highs? Odds tell us statistically that 70% of the time, price will stay inside of a range. So as price rallies on up here aggressively, okay, when we start moving back into these dual bearish order blocks, it's reasonable to expect this market to try to look for sell scenarios or sell patterns. Okay, now where's the range at this point? Because we have this high here, and this low where it came from originally down here. So the order block that resides down here is this one. Okay, so if we sell up in here, we could reasonably expect it to come back down into this area. Okay, and maybe retest this low. But again, we have a 70% odds that it's going to stay within this range. Okay, price comes down. Does it break this low? No. What does it do? It rallies once more. Okay, why is it rallying up here? We have a high here. We have a short-term high here. Okay, this is a bearish order block that trades back into. This is a bearish order block that it trades back into. Okay, the range is this short-term high to this short-term low. Notice we did not classify it as this low because this is the true range here. This is the range that has not been violated, this high and this low. So as we have this short-term high, price moves from this point down, does not break this low, and rallies back up. Where does it rally up to? Above these short-term highs, taking out any liquidity that's resting in the marketplace. This short-term high here and this short-term high here, okay, both being order blocks that it does trade within. And then what does it do? It sells back off. Now, we do see price violate this low and the old reference point low here. Okay, it breaks below it. It sweeps back into the range here. Now, what's going on here? Well, we have a new range. We have this high here, and we have a new range low here. Okay, so we have this high to this low. Price rallies on up, and where's it go back to? A previous bearish order block right here. This candle right there. Draw that out in time. You see it, tag it right there. So now, what are we saying here? What's the premise behind this? Well, if you understand where we are in terms of the present trading range, you don't need a directional premise. Okay, you can trade very, very short term, either intraday or day trading or short term trading. Okay, with a premise in mind that as long as you know you're not going to overstay your welcome, okay, you have the likelihood of taking short term intraday scalps, short term intraday price swings, and short term trading, and capture a lot of these little moves here. Now, if you're very disciplined, you can do this over and over and over again with a good pair like this. Like I said, the Swissy is pretty volatile, and this gives you a lot of opportunities to trade like this. I don't trade the Swissy a lot, but if I do trade it, I trade it in this capacity because I don't feel that it's one of the pairs that I can trust because it's very, very volatile. It comes down a lot, takes out lows, takes out highs, and its characteristic is very range bound, and you can trade a lot of setups with this pair. You have a bullish order block here. Okay, price dips down into rallies. Okay, and you can take profits in here. Yes, it violates it and goes through it. Okay, but look at the profit potential that's available by understanding where you are in the range. That's 280 pips catching a buy like that. Just so you know, I'm not cherry picking. We have a dealing range low here and a dealing range low high here. Okay, price rallies back up to what? The old order block right here. Sells off. Where's it go down to? This range high to this range low to the previous bullish order block right here. Okay, boom, buy it. Take profits at old highs. Okay, sure, you can hold on to higher prices, but there's no guarantee it's going to do it. Remember, we have a 70% chance that price will stay within a range. So you can take a large portion of your trade-off, maybe 80% leave 20% on these types of incidences. That's what we're talking about. When we talk about taking partial portions of our trade-off, you want to be doing it with a systematic approach to it, but a framework as to why you're doing it. Because as we trade up to here, there's no guarantee this is going to continue going up. It could deeply retrace, and you'll have to ride through all that. And many times, it could just continue to trade lower and blow out your stop. So it's nicer as a trader to take some profits as a logical place of resistance where we could see potentially a retracement, where we don't want to ride through that. Okay, because if we're at the extreme of the range, we want to hopefully see this continuation, but there's no guarantee it's going to happen. So by having that understanding, we're trading with a 70% chance of, yes, this may hold us lower, but you're taking 100% likelihood of taking a large portion of your trade off. So let's say you took 80% off at this high from a low down here that you went long on a previous order block. You're trading inside the range here. This is your high and this is your low. We know that 70% of the time, or 70% odds that you are not going to see a higher breakout. That means take a larger portion of your trade off. So let's say we took 80% off from a long down here, leave 20% on. Look what it does. You end up making more money on the 20% remaining in the position than you did on your 80% taking it off from here to here. Okay? And you're keeping risk low, you're minimizing risk and maximizing profit potential. Okay? Now we have another range here. We have a low and a high. So this high and this low. Bullish order block is right here, dips down into it. 70% likelihood that this range low will maintain and this range high will maintain. So what do? You can be a buyer here and taking profits here. If that's the case, and we buy right at the order block high, there's 343 pips made available. and taking out again 80% of the position right here, leaving 20% on, and look what it does. It gives you a little bit more of a pump in that position. Now we have another dealing range. We have this low and this high. Okay, price comes down, and here is your bullish order block right in here. This right here would have amounted to a loss. Okay, I want to give you opportunities where this would not work. Okay, I don't want to sit here and look at a chart and cherry pick everything in hindsight and say, look how great I am and look how great the tools are. But this is one where if you were trying to capitalize on this range phenomenon, it didn't work. But I'm going to ask you a question. If you use your fibs in conjunction with this, wouldn't this be below the 79% retracement level? So would this swing qualify? Up here it would, but you didn't dip down into the order block far enough back here. Okay, so forgive me, I can't remember if I went over this pattern here, this bearish order block here, but we have when price breaks back down below inside this dealing range high here, and we violated this low here, we have a new range low and this range high up here. But inside of this range, we have this high, this high, this high, this high, this high, this high. So each one of these are potential dealing ranges. The way we use it and let's put them on the chart so you can see it. I'll leave this one alone because that's a Sunday, I'm sure. Okay, so we have, and this low down here, which I'll just use a full horizontal for that. So we have this range, and we have this range, and we have this range, and we have the old high back here and the low here prior to this rally up. Let's incorporate our fib. Okay, price retraces to well, this level here absolutely means nothing to me, so I wouldn't look at this fib level as a means of interest. I like the 62. From this high here, we still don't have anything. From this high here, we have nothing still. We have this high here, and suddenly we have a sweet spot. Now, what's nice about this one is we have old lows here. Actually, we have a nice fractal low that was broken to the downside, and we came back and retested it. Okay, see how prices move back into this area here? See this low, lower low, higher low. Okay, so we have a fractal here. We broke through it and then retested it in here. Okay, back in this area over here. But now look behind price. Okay, what do you see? In this consolidation in here, okay, what do you see? Where's the order block at? See it? Right there. So inside this range, we've rallied back up. I would not, this is where we're getting at with this, I would not be willing to assume new long positions trading up against this bearish order block. And on a daily chart, and we're at the extreme of the range, again, we're getting up to these levels here, and let me borrow this level. Here's that swing high. So the dealing range highs here. We're off the lows here. We got a 70% likelihood this is going to maintain price. Okay, that's what statistics tell us. Price spends 70% of the time inside of a range. So as we get up into this level, look at what we're doing. Would you be willing to buy up here, up against a bearish order block at the far extreme of a dealing range on a daily chart like this. Okay, so inside this range, okay, we have very little to go by in terms of statistical odds. In fact, it's statistically against us. Okay, the odds are that this is not likely to continue higher. Okay, and that's the benefit of looking at where we are in the current range. Now let's go back to this level over here. Okay, down in here we have a bullish order block. Okay, and very handsome. You can see how that was handled there. As price starts to break down, notice how we got very close to it, but never violated it. Okay, so price stayed what? Inside the range. Price eventually comes down to that range. Okay, breaks it a little bit, but look what it does. It trades deep back into the range again. Sweeps below it again. Works it a couple times, but then eventually moves outside of the range. But look how long it took to get outside of that range. A very long time. Going back through all of these levels, okay, we can see many instances where trading, by defining where we are in terms of the current trading range, you could trade counter swing trades both directions. Okay, like this level in here. Okay, you have a bearish order block here, you have a bearish order block here. And I apologize if this seems like a whole lot of just looking at a chart and grabbing the best positions. I promise you, if you spend a week going through every pair that you'd like to trade and go through and look at highs and lows, okay, old highs and lows, and see where prices retraced and all of the retracements back to the highs and lows, okay, you'll see that there are absolutely beautiful trading opportunities where over and over and over again you could be really finding a lot of times what many traders can't see on the chart. This low to this high, really handsome opportunity. Again, now once we get up here, what do? We can look for a bearish scenario. If you're a harmonic trader, you can look for bearish bats, bearish butterflies, bearish Gartleys up in here, bearish turtle soups, bearish stochastics, bearish MACD divergence, you know, head and shoulders formations, all those types of patterns in this area here. Trade it looking for what? The retracement back into the dealing range here. And this is your bullish order block here. And we would look to take a exit point and maybe even look for a bullish pattern to trade in here with the expectation of this high being retested. So it gives you a means of trading at the very extreme of each range. Okay, so when you're looking at the chart, you want to be looking at doing at least 90% of your trades at the far extreme of each range that you're working within. Okay, the likelihood of trading in the middle of the range is much lower if you trade in the middle of the range versus the extreme outer range, like up in here. Being a seller up here versus being a buyer, it goes without saying. It's pretty obvious. Okay, if the price has rallied this far, okay, just like we see here, price rallies this far one direction, you're on the outer cusp, okay, the outer range of this trading range. The likelihood of it continuing up is far less than the likelihood of it going lower. Okay, so again, the question is where are we in the range, and where is the path of least resistance? And if you think like that, looking at the charts, defining the current trading range that we're working within, and understanding the mechanics are 70% of the time price stays in a range. It does not mean 100% of the time it's going to be like that, but notice what we're doing. We're looking for trades back and forth each direction and not having to rely on a trend directional bias like we talked about in the first two volumes. And the reason why I'm including this is because I know some of you simply can't trust the moving averages, and you want to have something that has a lot more action in your trading. If you start trading inside the range like this, you're going to have more trades than you ever dreamed of. Okay, but you're also going to have the likelihood of losing more times than you probably would if you just stayed on one side of the marketplace like we discussed on volumes 1 and 2. So To recap, when we look at price, we want to find out again, where are we at in the range? What dealing range highs and lows are we working within? And the likelihood of that range staying intact is 70%. Okay, so that's pretty good statistical odds. And if you add that equation with the order blocks and you keep your profits very concise, very uh, uh, you know, objective. In other words, this is an area where you would expect to see selling because we had selling all through here. But more importantly, we have a very clear bearish order block. Price went right up in that level, and what happened? True to form, dropped down. Look at this. It goes right back into a previous bullish order block. There's a perfect opportunity to take your profits. Just doing a trade like that, okay? Just simply doing something like that, here to here, it's 180 pips. Would it be it would be too far for me to say that realistically there's a good 60 pips in that you could have taken out? Think about that. It's not getting every high and low. It's about getting portions of these moves, okay, and banking them and compounding the growth of your equity over a period of time. And I promise you, if you spend time looking at the charts and studying it, you'll see many, many more opportunities trading inside the range.